Australia. It's a land of endless opportunity and possibility. But how can you best tap into it? In this investment series, we'll be following real live investors just like you, who are looking for unique investment opportunities.
We can take some risks now.
I want some sort of capital stability.
I want to know that my money's in good hands.
Together with their own financial advisor, they'll be given behind-the-scenes access to some of the best money managers from around the globe. Supported by the CEO of the Financial Services Council, these fund managers will face the guardians, the industry heavyweights whose job it will be to make sure our investors have all the answers they need to make informed investment decisions.
Can we bring it back to basics and just clarify what the fund is providing them exposure to?
Traditionally, though, clients have preferred to actually manage their cash holdings outside, and yet you're sort of making that judgment call for them.
Of that income, how much would come from dividends versus the option strategies and other sources?
Welcome to our new investment series. Last time on the investment series, you saw successful businesswoman Maria Cook, introduced to 3 new funds by her advisor, Rick Aronson.
Property in Australia at the moment is doing really, really well, but we do want the flexibility of more income.
Maria's looking for opportunity to put into her investment portfolio and has plenty of questions about how these funds fit.
It's all about taking somebody else's money and looking after it for them and knowing that they trust you to do the very best you can with it.
If you don't go and visit the asset, you can't make that decision. You listen to what the company or to what the market tells you, and you really miss out a very important piece of the jigsaw.
Your overseas trip, a caravan you want to buy, whatever it may be, our objective is to really help you achieve that retirement goal.
So we're giving her a very rare opportunity. She gets to go behind the scenes and see the actual fund managers pitch these funds to our guardians. The guardians are going to grill the fund managers, and Maria has a lot of questions that she needs answered. Let's hope she finds the answers she's looking for to get opportunity into her investment portfolio. The guardians are the investment industry heavyweights, who are responsible for ensuring only the highest quality investment products reach the public.
Our relationship with managers needs to be a working relationship.
I wouldn't say it's collaboration because we have to provide objective opinion and insight on those managers.
It's up to us to make sure that members can feel safe when they're investing with our company, to make sure that they've got the best access to the best possible investments.
Amanda Gillespie is the joint CEO of Lonsec Fiscal Holdings. David Wright is the director and joint founder of Zenith Investment Partners. And Matt Heiner is the joint managing director of Net Wealth. First up to face the guardians is the Senior Vice President of the Capital Group, Andy Budden.
Hello, Guardians. I'd like to introduce the Capital Group World Dividend Growers Fund. Australians face significant and competing challenges when they're investing for retirement. In particular, they need to achieve current income, but at the same time, they also need to grow their future income so that it can be protected against inflation. Now, traditionally, the way that Australian investors have approached these objectives is to invest in a combination of term deposits, quality fixed income, and also high dividend yielding Aussie stocks. But it's not perfect. It is overly dependent upon dividend income that comes from just a handful of stocks, and in addition, a large part of it comes from a single industry, which is financials. So we think this approach can be enhanced by including an additional allocation to a special type of global equity portfolio which focuses on dividend growth stocks. So companies that pay a dividend and then grow that dividend from year to year. And the proposition for the fund is that it achieves superior returns with greater stability of returns, and in addition it also has an attractive income stream. And the Capital Group is well qualified to manage this strategy with 1.8 trillion Aussie dollars of actively managed assets, and in addition, more than 80 years of experience of identifying and investing in dividend growth companies.
Andy has made his pitch on world dividend growers. Now's the time for the Guardians to ask more detail.
Andy, you've referenced the size and the depth of Capital Group a few times. We're aware that Capital Group is one of the biggest fund managers, maybe the biggest active manager in the world, but it's not a well-known brand in Australia. Do you want to maybe just give a little bit of background to who Capital Group is and where you're located?
So we are one of the largest active fund managers in the world, and in addition, we're also one of the largest privately held managers in the world. We're based in Los Angeles, but we have a presence around the world. And we are defined by our mission to produce consistently superior long-term returns for our clients, and everything is oriented around that mission.
And in Australia, it's hard to talk about income stocks or yield stocks without looking at the benefits of franking credits, particularly to a retiree. Can your fund stack up compared to some of the high yield stocks in Australia, and how's it going to perform on an after-tax basis?
Well, I think you've brought up possibly one of the most important points of this conversation, which is that investing in Aussie stocks does provide a very significant and important tax benefit for local investors, which a global fund cannot. And that is one of the reasons why we are absolutely not suggesting that World Dividend Growers is a replacement for Australian stocks. And instead, we're saying that it is a complement to. And in particular, it helps to reduce the concentration of risk that we feel that an Australian stock portfolio can deliver.
Andy, we've spoken about the geographic diversity and opportunity set of the portfolio. Can you give us an insight into the industry diversification that the portfolio can provide?
I do think it's very interesting to look at World Dividend Growers and to see how diverse it is in its industry exposure. People do tend to think of dividend stocks as being predominantly from maybe utilities and consumer staples. When you switch the focus to instead being on dividend growth, what you see is there's tremendous opportunities across actually a wide range of different industries, including something like technology. Traditionally, people do not associate the technology sector with dividends, but we are seeing that that's actually changing over time.
Andy, can we perhaps tease out a bit more in terms of growth expectations or total return, what an investor could expect from this fund compared to investing in the global equity benchmark, for example, or a mainstream global equity fund?
Sure. So there's a very strong message that comes out there that over the last 25 years, global stocks have delivered a return of something like 8.5% per annum. Companies that don't pay a dividend have performed much worse than that. Companies that pay a dividend but then cut it have done slightly better, but still worse than the overall market. Companies that pay a dividend but then don't grow that dividend, even they've underperformed the broader market. And the only category of dividend-paying stocks that has done better than the market is actually dividend growth stocks, which have outperformed the market by something like 2% per annum over the last 25 years. So I think it's a very compelling message that dividend growth stocks don't just deliver an attractive stream of income that should grow over time, but actually the total return proposition is massively compelling as well.
Andy, we've really enjoyed hearing about the Capital Group World Dividend Growers strategy today. We thank you for your time.
Thank you, Guardians.
The Guardian seems satisfied, but what will Maria and Rick have to say?
Oh, that was interesting. Now I understand it's really around investing in international shares, but specifically looking for companies that are growing their dividend over time, so that you get, not only do you get dividends, but you also get capital growth because the companies are doing well. What did you think?
I like the strategy of investing in companies with good dividend growth, because if a company's got good dividend growth, then they're a solid company, they're doing the right thing, they've got good cash flow management. I like all of that.
The strategy's great. I know that they're an unknown brand in our country, but if you think of it, they're kind of like the AMP of America, if you want to call it that. The other thing I really liked about it was the fact that if I've got a client such as you that's has too many Australian shares and they still want to get dividends, but they need to diversify into a different asset class, then it allows you to then, okay, well, let's have an international exposure and still get dividends. Well, let's have a look at IDoubleF and see what they've got to offer.
Next up is the portfolio manager from IDoubleF, Dan Farmer.
Hi, I'm Dan Farmer and I'm a Senior Portfolio Manager at IDoubleF. Today I'd just like to give you some insight onto the multi-mix range of funds that is offered by IDoubleF. At the heart of the multi-mix philosophy is really a belief that no single investment manager can be the best performer in all markets, all asset classes, all strategies, all of the time. At Multimix, we really believe that by investing in a portfolio of several carefully selected investment managers, our investors will benefit from having many of the best investment minds around the globe applying their specialist investment skills to their portfolios. And this suite of multi-mix funds is really designed to deliver a range of investment outcomes, from the lower return, lower risk type products, right through the spectrum to the higher return, higher risk products. When we're building our products, the first step we go through is determining an optimal long-term asset allocation to each of the broad asset classes. And we do this to make sure our investors have the right mix of equities, bonds, cash in their portfolios, so they get the right long-term outcomes of risk and return for each of our products. Once we have this asset allocation strategy set, we then go out and look for the managers with the right skills to manage that strategy for us. When you take all this together, we think the investor and their advisor should have confidence that they have a well-diversified, actively managed investment solution working with them to help them achieve their financial goals.
Dan's fund is a different strategy with his multi-mix approach. What questions will this raise from the Guardians?
What are some of the things that you look for when you're looking for a new manager to add to the portfolio?
Now, what we look for in a manager is very important. Key is people. We invest with an investment manager, we're really investing in the people. We're really looking for their alignment of interests, that those investment managers are passionate about their investment portfolio and that they have a process that through time will deliver consistent returns. And that consistency is very important in our products because we are blending these managers together.
How long would you typically have a manager in the portfolio? Is there an average time that is seen as optimal?
We don't set an average time, but we do turn managers over. So we're not afraid to remove managers from the portfolio. And typically we're removing managers simply because we've found a better manager in the marketplace. We're constantly searching out there for new strategies, new investment managers. And over the last 3 years, we've removed around 10 managers.
What would be a trigger to make a change to the mix of asset classes within one of the funds?
Sure. Well, strategic tilting is a really important tool that we use in our funds to both enhance returns to our investors, but importantly, control risk in their portfolios. And by strategic tilting, we simply mean moving away from our long-term optimal asset allocation when we see markets at extreme points in valuation. So if we see a market extremely overvalued, we'll tilt away from that market. Or if we see a big opportunity and see a particular asset class extremely undervalued, we might tilt into that asset class. So we're just doing this with a recognition that markets are volatile and valuations do move around, and we see it as very important that we manage that risk in our investors' portfolios.
So do they tend to be small, infrequent types of asset allocation moves, or much more frequent, larger asset allocation moves?
We're certainly targeting the larger moves. So we're looking for what we call extreme points in the valuation. So they don't happen all that frequently, whereas a tactical asset allocation approach is far shorter term. We're taking longer term views, so these positions will be on typically for a couple of months at least. And perhaps as an example, just to put some colour on it, is a recent tilt we did in the Australian dollar, where the Aussie dollar was up at $1.10 US. We felt that was an extreme overvaluation. So we reduced our hedge ratios, brought our exposure to the Australian dollar down, and our investors have really benefited from that position.
Dan, in terms of the rationale for investing in a multi-mix product, what would you say is the key reason that you would consider multi-mix?
Because we have a range of funds, it's got a really broad application. We see multi-mix in our client base being used in a variety of ways. So some investors and their advisors don't necessarily want to engage that closely on the investment decisions. In other cases where the investor and advisor are really wanting to get closer to their investment decisions, we also see multi-mix used, but in a couple of different ways. So some advisors really take an asset allocation model approach, where the advisor will determine the asset allocation with their investor and then use multi-mix sector funds to really implement that strategy. So there's a variety of ways, but I guess the key reason why you wouldn't use multi-mix is you are getting that diversity. We're doing all that manager work underneath, where you are taking one of our multi-sector funds, the asset allocation is being managed for you and rebalanced for you in a very efficient manner.
Thanks for coming in, Dan. Appreciate it.
Thank you, Guardians.
With the Guardian's questions answered, it's now up to Maria and Rick for their assessment of the fund.
That was good to see what Dan had to say. The thing that I had to get my head around is that unlike the Capital Group, which is just one fund, what the IDoubleF offering is kind of like a whole menu of offerings. You can get the Balance Fund or the Growth Fund, you can get the Australian Share Fund or the Defensive Fund. You've got a whole portfolio of different funds to use. And I guess the other thing that summarises it is the fact that instead of investing in specific investments like Telstra or BHP, they're investing in fund managers. What did you think?
I suppose I was a little bit confused perhaps about the layers of fund management. You know, so many players between where you were investing and where it was ending up.
The IDoubleF fund is actually quite good because they manage that asset allocation on your behalf. It's quite a good fund to set your money and let it just do what it needs to do. And you know that it's very, very diversified and across a whole platform of different fund managers. So even if one goes bad, then the other ones are still doing nicely. Well, it'd be great to now watch Tim from AMP Capital and understand how his fund works.
Next up is the head of global listed infrastructure for AMP Capital, Tim Humphries.
Hello Guardians, I'm Tim Humphries, Head of Global Listed Infrastructure at AMP Capital. I believe that infrastructure is the biggest investment thematic of my lifetime. Governments in the developed markets need to replace old, ageing and obsolete infrastructure that's been underinvested in for decades. In the emerging economies, infrastructure is being built for the very first time. Looking at some of the studies, McKinsey, for example, they estimate that $57 trillion needs to be spent on infrastructure worldwide by 2030. Investing into global listed infrastructure not only gives you a high yield of around 3 to 4%, but a yield that's growing at around 10% each year. You also get the security of the yield because of the long-term regulation and the contracts that infrastructure companies have. In addition, a globally diversified portfolio allows you to access the highest quality companies in the world and also to access themes that we can't currently get here in Australia. At AMP Capital, infrastructure is in our DNA. We've been investing into infrastructure for over 25 years. Now is a fantastic time for investors to look at global listed infrastructure. Thank you.
The Guardians are keen to question Tim around infrastructure as an investment opportunity.
Infrastructure as an asset class isn't well understood. Can we take a step back to the basics and describe what actually is infrastructure?
We define infrastructure as companies that have very good long-term regulation or have very good long-term contracts that deliver stable cash flow growth through any economic cycle. So these are things such as pipelines, such as water utilities, such as satellite companies that have a 15-year contract on every satellite they put into space.
How much of the fund, or can the fund at all, invest in development of infrastructure assets as opposed to existing assets that are already built and delivering a consistent flow of income?
Over the last few years, there's been a lot of infrastructure developments where people have built a toll road, hoping that traffic will turn up once the toll road's been built, and the traffic never appears, and the toll road gets into strife. We don't think that that's the kind of risk investors want. So we only invest in mature companies with mature assets where you have certainty and knowledge that the cash flow is going to be there year in, year out.
What would you say is the biggest risks that are currently sitting in your portfolio or that investors should be aware of when investing in infrastructure?
We have to recognise at the end of the day that we are invested into shares, and we will perform like shares in times of strife or stress within the financial system. And we saw this through the financial crisis. So that's why we think that allocating to listed infrastructure from a global equity portfolio makes most sense, because we are invested in shares at the end of the day, but in a more defensive kind of share than the broader equity market.
A client that was, say, 45 to 50, balanced investor looking to invest for, say, 5 to 7 years, what might they consider allocating to infrastructure within their portfolio, and what asset class are they best suited to actually allocate it within?
We think for a balanced portfolio for someone of that age, a 10% kind of allocation to listed infrastructure is appropriate. It depends upon what their current portfolio is made up of. We think the global equity allocation is where most people will allocate to listed infrastructure from, both now and in the future.
On behalf of the Guardians, Tim, thanks for your insight into both your strategy and the broader infrastructure asset class today. It's an asset class that investors, I think, should understand better, because let's face it, we're using a lot of those assets in our everyday lives. So thanks again for your time.
Thank you, Guardians.
The Guardians have had their turn, but what will Maria and Rick think of the opportunity?
Well, that was great to see Tim from the AMP Capital Global Infrastructure Fund. He's a character.
He sure is.
He loves what he does, you can tell. This fund was much easier for me to understand. It just invests in 35 to 45 global infrastructure equities. So they're shares, right?
I really enjoyed that presentation. I loved the energy. I loved that he was talking to somebody like me who doesn't have the jargon. You know, he was talking about infrastructure, there being water. I understand water. I understand gas. I understand pipelines. I understand satellites. So he had me. And I liked the fact that he had an engineering degree. He was the right person to go and look at those assets and know what he's looking at. And I loved the fact that he's out there walking on the pipeline. That made me feel like it was really strong and secure.
And the thing I like about investing in infrastructure, and it doesn't mean to say we should put 100% of your money into infrastructure, but the infrastructure assets are long-term assets. A pipeline stays for a long time and it gets a steady income stream. It doesn't mean to say that the asset's going to be really steady in terms of its performance, but the income stream should be steady. And the thing you need to remember is you are still investing in equities, or shares is what's the same thing. And so if the market goes up, they'll probably go up with it. And if the market falls, they'll fall. It's not going to act like a term deposit. It's still going to be volatile. If we did allocate money to it, it's about allocating only a portion of your money to that in the expectation that it'll do well.
And you know I don't like term deposits anyway, Rick.
Today, our investor Maria got to see our fund managers pitch their funds to our Guardians.
At AMP Capital, infrastructure is in our DNA. We've been investing into infrastructure for over 25 years.
They need to achieve current income, but at the same time, they also need to grow their future income.
When we're building our products, the first step we go through is determining an optimal long-term asset allocation. And we do this to make sure our investors have the right mix of equities, bonds, cash in their portfolio.
Let's hope she got the answer she's looking for as she sits down with her advisor, Rick Aronson, to see if any of them are suitable for her investment portfolio.
So it's been quite a journey we've been through, Maria. When we spoke initially, you'd sold your property and you've now got some money to invest, and remember, our objective was to look for an opportunity to invest that money, which was, if we take it back to our tree analogy, it was around getting something that was going to grow, but also provide fruit, which is the income that's going to give you a good standard of living as you move into retirement. We've now looked at the 3 fund managers. How did you find the process from start to finish?
A really interesting journey. It's nice to see the fund on paper and then through the iPad, but then to actually have an opportunity to hear directly the fund managers, that's a very important and different kind of opportunity than most people have. So I enjoyed that. You think you've made up your mind, and then you see the fund manager and you think, oh, okay, there's a whole level of information that I want to now sort of consider. So that's been really good.
It was really good to have the Guardians there. I liked the fact that we could just sit and watch while they really grilled the fund manager and asked them the hard questions. How did you find the Guardians?
Well, it was interesting for me because I really, for the first time, understood that they existed. I probably realised that the funds got rated, but I don't know how or by whom. But I was really impressed with the Guardians.
Yeah. Well, in our industry, in a normal circumstance, we're using those Guardians, whether that's Lonsec or whomever, all the time to help us to rate funds so that we can screen them out and then make a decision for you guys in terms of which fund to use. So there's no doubt about it, they play a very important role in our industry. Well, thanks, Maria, for coming along. I really hope you enjoyed the process.
Well, thanks for inviting me. I've learnt a considerable amount. I've really enjoyed the process, and I think you're going to find a far more informed investor in the future. So thanks, Rick.
You'll probably continue asking me hard questions, I've no doubt. I look forward to catching up again soon.
Thanks, Rick.
Head to theinvestmentseries.com.au to better understand how you can change your investment future. Gain greater insights into the fund managers featured in the show. And hear more from our Guardians on the featured funds. This is the start of your journey to making better investment decisions. Find out how you can invest today. You can also connect with us on LinkedIn and Facebook by searching No More Practice. Next week on the Investment Series, you'll be meeting Bruce Heim, a retired accountant who's looking for ways to change his financial future in retirement.
How long will I live? How much funds do I need, therefore? It's that sort of security and what income I can get out of that I can live on and still maintain decent funds.
Together with his advisor Sam Henderson, they'll be meeting the 3 fund managers who'll be pitching their funds to our Guardians.
It's the thing you least expect to go wrong that will go wrong, such as the uncertainty in the world.
Regular income stream, low volatility and competitive fees. Those 3 things were very important.
If you're investing in something that you don't fully understand, don't invest in it.
Let's hope Bruce finds a fund that's suitable for his retirement future.